Chris Picuro here, teaching tax flow. Welcome back to Tax Tip Tuesday. Ironically, we're at our office here in Franklin, Tennessee. We share space with a medical practice based out of Vanderbilt University. Today, we're going to talk about maximizing your medical deductions. This is the topic of our podcast this week. And what we have to understand is, in general, medical expenses are personal. And there's typically, unless the proper planning is done, not a tax deduction for these benefits. Now, as far as health insurance premiums, typically health insurance premiums are going to be deductible if you do one of two things. One, you own a business and you have a profit. In that case, you can deduct those health insurance premiums right on the first page of your tax return. Now, if you own a business and you're a sole proprietor or single member LLC, the deduction is real simple. It just goes right on your adjustments to income. If you're an S corporation owner, it works a little differently. Those medical insurance premiums would go on your W-2 and ultimately get deducted on your personal return. That's a little fancy, so definitely check out some of our content on S corporations if that pertains to you. If you're a C corporation, you should be arranging it so your medical insurance is an employee benefit. So that would be a non-taxable employee fringe benefit if it is properly taken care of. And that leads me to the next issue. What happens for those out-of-pocket medical expenses? Your deductibles for prescriptions, for medical, seeing a doctor or a dentist or whatever. Well, in general, those are personal deductions. If you do itemize your deductions, meaning you have a list of deductions that exceeds your standard deduction, those deductions are deductible on your tax return, but only the extent that exceeds 7.5% of your adjusted gross income. So that's a lot of medical deductions. So if you make $200,000 and you itemize your deductions, only the amount that exceeds $15,000 would be deductible. Oh, that's a bummer. But there is a remedy for this, and that would be considering what's called a health savings account. First of all, you have to determine if you're eligible for a health savings account. Then secondly, do you have an employer that offers an HSA? And if not, can you just contribute to one for yourself? Now, this is kind of cool because you can actually contribute to an HSA at times in 2024 and still count it for the 2023 tax return. So the health savings account allows you to get a tax deduction in the year you put the money in, or put it in tax pre-tax, that the money grown in the health savings account tax deferred. And if you use it for medical expenses, it's ultimately tax-free. So think about the health savings account as if a traditional IRA and a Roth IRA had a baby, and the attributes of both of them that are good were combined, and those expenses were used for health insurance. So here's the bottom line. Check out our podcast this week, the Teaching Tax Flow podcast, about maximizing your medical deductions. There are some more advanced things if you own a business that we're going to dive into. And have an awesome rest of the day. Take care.